Good afternoon and thanks for joining us. July was a rough month in the U.S. stock market. Although the equity markets closed higher in the last 2 trading days, the damage of consecutive week losing streaks took its toll. For the full month, the Dow Jones Industrial Average managed a slim gain, but the NASDAQ Composite, the S&P 500, and the Russell 2000 all fell. The market was driven down primarily by anxieties over the massive AI capital expenditures by the so-called hyperscalers. After Alphabet and Tesla reported CapEx-related negative cash flows, a steep tech sell-off ensued. But late in the final week of trading, sentiment flipped. Triggered by Microsoft's quarterly earnings report, their stock surged 16% and added $450 billion to its market capitalization in one day. To put that into perspective, $450 billion is bigger than the entire equity markets in South Africa, Turkey, Finland, and Vietnam. Amazon was up 15% on the last trading day because of their cloud computing revenue that expanded 37% year over year, the best since 2022, and the company reaffirmed their $220 billion commitment to further AI infrastructure spending. And there was no backing down at Google, which raised its 2026 CapEx outlook by $15 billion to $205 billion. The bond market moved in the opposite direction after Fed Chair Warsh announced leaving interest rates unchanged despite the current inflation rate of 3.3%. That remains consistently above their 2% goal. The result was yields on 10 and 30-year treasuries rose and the 2-year yield fell. DoubleLine CEO Jeffrey Gundlach commented that if you really want to get to 2%, you have to raise interest rates. There are signs that our economy is cooling, and the war in Iran is not helping. Advanced numbers are pointing to a 1.5% annualized GDP rate. Crude oil prices rose again last month, with Brent crude hitting $102 a barrel before falling back to the mid-80s. Which is why ExxonMobil reported their second quarter profits doubled to $14 billion on revenues of $116 billion. And Chevron reported quarterly profits of $22 billion, 40% higher than last year. Maybe last month is an example of a bull market climbing a wall of worry. After all, our unemployment rate is about 4.2%, a long way from the 14% during COVID. First-time applications for unemployment benefits fell last week to the lowest level since 1969. And year-to-date, the Dow, the S&P, and the NASDAQ are all up over 9%, and the small-cap Russell 2000 is up over 18%. Thank you for joining us. We hope to see you next month.